Hello and welcome to the Ultimate Trading Masterclass Trade Management module, Types of Orders. In this section, we will look at the different types of orders that you can place in the market, examine which type best fits the trades that you're going to enter, as well as how to manage the expectation of entry points. In this lesson, you will learn the different order types available to traders. You will learn how to place trades using market orders, you'll learn how to place trades using limit orders, and finally, you'll learn how to place trades using contingent orders. This section will focus on trades in shares that are on the ASX, and it is important to note that while short selling is available on the ASX, this is not supported by most trading platforms unless you are using CFDs. When you have done your market analysis and decide which share you're going to trade, it isn't always as straightforward as just placing a buy order. There may be instances where you have decided on an entry level that price has not yet reached, or you may be waiting for an area of support or resistance to be broken before entering your position. Although buying at a current level is easy to execute, this style of entry may not always be the best option. There are different types of orders that can greatly assist you in getting into the market at a particular point in the future, and all have different characteristics that are suited to particular market conditions. Let's first look at market orders. A market order is used when a trader intends to buy a share at the best available current price. These types of orders are generally executed immediately, as you have set no parameters around price limits or timeframes. The platform displays share prices using a bid price and an ask price. The bid price will always be lower than the ask price, with the differences in these two prices referred to as the spread. There are two main types of market orders. The first one, the market order, will look to fully fill your order by taking the current bid offer price and any additional shares at lower or higher prices, market conditions considering. By placing a market order, you can end up paying a higher average price than the current offer price when buying at the market, or receive a slightly lower price than the current bid price when selling at market. The next type of order is a market to limit order. This type of market order will fill your order at the offer price at the time your order first fills. If there are insufficient shares at this price, the remaining part of the order will sit at this place until it is filled or cancelled. Before placing a market order with your broker, you should understand what type of market order they provide. If it is a market order, then you should understand how many price steps they move in order to fill your trade at the outset. Let's now look at market buy orders. When a market executed buy order is placed, the trader is willing to pay the ask price, and when a market sell order is placed, the trader is willing to accept the bid price. When you want to place a buy market order, you are essentially entering a position long at the current market price. You will use this type of order if you predict that the market will be going up from around the current level. The order pads used in this tutorial are from the Iris trading platform, but most platform order pads will have the same options available. You can see in the subheading order type that market is selected and the buy button is highlighted. In a real example, you may see price consolidating at a level of support that you think will hold, so you would want to enter the market at this point with no delay. This type of trading environment would warrant using a market buy order, because if the entry is delayed, you may miss an opportunity. Also, if you don't believe that price is going any lower, it would make sense to enter at this level without delay. When you want to place a sell market order, you're essentially selling a position you currently own at the current market price. You'll use this type of order if you are willing to settle for the current available price of the share. Once again, you can see that the order type is set to market on the order pad on the screen, and the sell button is highlighted. In a real example, you may see price struggling to break a level of resistance that you think will hold, so you would want to sell an existing position at this point with no delay. This type of trading environment would warrant using a market sell order, because if the entry is delayed, you could miss out on potential profit if the current price of the share begins to fall. Also, you don't believe that price is going any higher, so it would make sense to exit at this level without delay. Now let's take a look at limit orders. Limit orders are used when a trader intends to buy a share at a price point in the future. Although the limit price that is set by the trader is guaranteed, these types of orders aren't guaranteed to execute, as price will have to reach the specified price level for the order to be filled. Another option that is available with limit orders is choosing how much time you will give the share to reach the intended price point. The three available time periods are good for a day, good till cancelled, and good till a particular date. You can find these options on the order pad under the subheading duration. When you use a buy limit order, you're attempting to buy at a price that is different to the current price. There are a few reasons why you could use this order type, but the most likely is that you have identified an area of support that price is still above. You would expect that level to hold if price gets there and then move up. You can see in the subheading order type that limit is selected and the buy button is highlighted. In the real example that we can see on the screen, you can see this process in action. You can see that the green support line on the chart may provide an expected level of support, and you would like to buy if price reaches it. Rather than sit in front of the chart and wait, a buy limit order can be placed at a support price, and the share can be given the time to move in that direction. When you use a sell limit order, you're attempting to close an existing open long position that is higher or better than the current price. Again, there are a few reasons why you could use this order type, but the most likely is that you have identified an area of resistance above the current price level. You would expect that price may halt if it reaches that zone and move down from the resistance. In the real example that we can see on the screen, you can see this process in action. You can see that the red resistance line on the chart may provide an expected level of resistance, and you would like to sell your long position if price reaches this level. Rather than sit in front of the chart and wait, a sell limit order can be placed at the resistance price. Now let's take a look at contingent orders. Contingent orders are orders that trigger when a particular market condition specified by the trader occurs. Contingent orders differ from limit orders because the trader can specify a different set of conditions for a trade to trigger, such as a trigger price being greater than the current price, greater or equal to the current price, less than the current price, or less than or equal to the current price. These extra conditions give a trader a greater amount of flexibility when placing trades, as they allow the market to move in a favourable manner before entering the position. Let's first look at contingent buy orders. When you use a contingent buy order, you're attempting to buy at a price that is higher or worse than the current price. Although you can place a contingent order to buy at a price lower than the current price, this can be achieved with a standard limit order. There are a few reasons why you could use this type of order, but the most likely is that you have identified an area of resistance that you would like to see broken prior to you attempting to go long, expecting that price will continue to move up if the zone is broken. You can see in the example on the screen that the order pad has an option to add a contingency strategy. You can first select your chosen share with the regular tab selected, and you can choose a condition that is appropriate to the price you would like to buy the share. You can choose between price or points as your preference, where price refers to the share price and points refers to the price ticks. For example, on the ASX, a point generally refers to 0.01 Australian dollars or 1 cent, whereas a point for US stocks is typically $1. After you select your contingent strategy, you can then select the price that you would like the contingent order to activate on. As an example, if the current price of BHP is around $40 and you would like to purchase the share at $42 once it has confirmed a break of a resistance zone, you would enter $42 in the price field. As you can see in the example on the screen, you can then enter your desired volume and the same limit price of $42 in the limit price field. In the real example that we can see on the screen, you can see this process in action. You can see that the red resistance line on the chart may provide an expected level of resistance, and you would like the price to break that zone before entering a long position. Rather than sit in front of the chart and wait, a contingent buy order can be placed just above the resistance line. The alternative is to say that close enough is good enough and just enter long with a market execution. This may be practical when resistance is near the current price. However, it's important to keep in mind that on larger timeframes, what appears to be a small range could be several percent. Now let's look at contingent sell orders. when you use a contingent sell order, you're attempting to sell your existing position at a price that is lower or worse than the current price. There are two main reasons why you would use this type of order. Firstly, you have identified a level of support below the current price that you think should hold. Should this level of support be broken, you may not want to continue trading this position long, so you can set a contingent sell order below the support to act as your stop loss. You can see in the example on the screen that a contingent sell order is placed below a level of support that, if breached, would be expected to continue moving lower. The second reason for placing a contingent sell order is that you have identified an area of resistance above the current price level that may stop it from going further. Rather than giving away all of your profits, you can place a contingent sell order lower than the current price, which will act as a stop loss if the share fails to break through the resistance, and you will still lock in some profit. If you are setting a take profit target above the current price, you can simply use a standard limit order to exit your position if the price target is reached. You can see in the example on the screen that the order pad has an option to add a contingency strategy. The regular tab is selected, and you can choose the condition that is most appropriate to the price you would like to buy the share. You then select the price that you would like the contingent order to activate on. As an example, if the current price of BHP is around $42 and you would like to sell your existing holding of BHP at $39.50 if it fails to break to a new high, you would enter $39.50 in the price field. As you can see in the example on the screen, you can then enter your desired volume and the same limit price of $39.50 in the limit price field. In the real example that we can see on the screen, you can see this process in action. You can see the red resistance line on the chart that may provide a strong obstacle to pass through, and you would like to sell your position if the share fails to break to a new high and comes back down to your set level. Once again, the alternative is to just sell with a market execution or a limit order at the current level, but by using that approach, you run the risk that the resistance level will break to the upside and the share will keep running up to its intended target. By placing the contingent sell order below the resistance, you're allowing the market to break the resistance line and give your trade a chance of fulfilling your expectations. Although you're getting a lower sell price, the trade-off is that you are giving the share the best opportunity to continue moving along without risking all of your gains in the process. Now let's look at combining contingent orders. Contingent orders can be placed as a combination when you use the one cancels the other, also known as OCO, a feature in the order pad. This feature allows you to place a stop loss and a take profit target simultaneously, effectively allowing the system to manage the trade. If the take profit target, the contingent sell order above price, is triggered first, it will cancel the stop loss order, contingent sell order below price. Conversely, if the stop loss order is triggered first, it will cancel the take profit order. You can see in the example on the screen that the order pad has OCO selected in the condition strategy, and this opens up two options, order 1 and order 2. You can place your take profit level and your stop loss level in these fields, and enter the level you wish to buy the share at in the order type window. It is important to remember that placing a contingent sell order as a stop loss doesn't necessarily guarantee the level will protect your position at that exact price. There are times when a share may open lower than your stop loss level on market open, where your trade will execute at the first available price, as you can see in the example on the screen. In this lesson, we have learned about the different order types that are available to traders. We learned how to place trades using market orders. We learned how to place trades using limit orders. And finally, we learned how to place trades using contingent orders. This concludes section 1 of the trade management module. In the next section, we will explain how to find and use the correct stop loss and take profit zones for your trades. These important levels will ensure that you give your trades the best chance of success without exposing you to unnecessary risk.